Hi, I'm Tekoa Da Silva, and I'm here today with Gary Savage, publisher of the Smart Money Tracker Investing Newsletter. Gary, welcome. Thank you for joining me.
Yeah, well, thanks for the invite, Tekoa.
Yeah, a pleasure to be with you. There's a lot that I wanted to ask you about today, and but before I do, about the markets, about gold, about market psychology and investor psychology. But before I do, I noticed that today, the Saturday here, August 2nd, you published a pretty important commentary indicating that you see some red flags developing in the market. So I'm wondering if we could jump right into that. Could you tell us a little bit about that, what you're seeing, and feel free to do a screen share if there's anything you'd like to show.
Sure. So there's a couple of things. We actually still have a Dow theory sell signal. And what that is you get it's called a uh, secondary low. So an intermediate degree correction. And if both the transports and the industrials form a secondary correction, then rally, but don't make a higher high and then come down and make a lower low, that constitutes a Dow theory sell signal. And we had one of those this year. And that the market, the S&P, and actually I think the tech as well, they all made a lower yearly cycle low than last year. So right off the bat, that's a warning sign. And it's a little premature to say whether or not for sure this is forming, but it's starting to look like we might have one of these megaphone, kind of an expanding wedge type pattern, and that's usually a topping pattern. And what it is the fundamentals are starting to deteriorate, and maybe you'll get a small correction, and then the market will recover, and then it rolls over, and then you get like a pretty scary correction, which is what we had back in April or May, blamed on the tariffs. The tariffs was the excuse for what was going to happen anyway. The market was just stretched way too far above the long-term mean, so it was going to correct anyway. And I call this the rubber band theory, but the further you stretch price away from the mean, whether it's to the upside or the downside, the more aggressive and violent the regression event tends to be as price moves back, usually to the mean and a little past it. So it was going to happen either way. Just the market would have found some other excuse to do what it needed to do, whether it was tariffs or something else. But the magnitude of that correction was a bit concerning. And then we get this big slingshot move that comes back up and makes a higher high. But we've got some potential warning signs that maybe this intermediate cycle has topped on Friday. I'll need to see a little bit more Monday. If we have follow through Monday and Tuesday, and especially if the S&P drops below the previous high, I would say that's a warning sign, and it's a good chance that we've got an intermediate top. We'll get a bounce here somewhere. Usually these things form as like an ABC move, so we'll get a B wave bounce. But if we get follow through and we break that support of the old high on the A wave down, then the odds are pretty good that the B wave bounce is not going to be able to make a higher high. And once it gets at least a little bit overbought, it'll roll over again. And if the fundamentals are deteriorating, then we could get maybe some kind of a mini crash event. And if it drops below the April low, that would confirm that we're forming a megaphone topping pattern. And basically what's happening is the fundamentals are deteriorating. The market's trying to price that in, and the Fed's trying to fight it. So they print a bunch of money, and that's why you get this volatile, aggressive move back up to new highs. But at some point, the fundamentals start to weigh on it again, and then you get maybe another semi-crash event, makes a lower low. The Fed will try to fight it, with more money printing, which would be good for gold and silver, and probably a lot of commodities. But But then at some point, the market, the fundamentals are just weighing too heavily on the market. We won't go back up and make a higher high. Maybe the rally only makes it halfway into the middle of the pattern, and then it'll break down, and it'll break down out of the bottom of the pattern, and you'll get I think it would be a cyclical bear market, not a secular one. I don't really think the secular bull market in stocks is over yet. AI is still pretty new, kind of in its infancy stage. We're not necessarily seeing the crazy overvaluation. Every Tom, Dick, and Harry's buying AI stocks, valuations at at absurd levels like the housing market was. Not like oil was in 2008, where we had tankers sitting in the Gulf with no place to unload the oil, but the price was still going up. So I don't know that we're at a secular bull market top, but we might be about ready to start a cyclical bear market that could last maybe for a year or so. But then I think governments will panic and print more money, and we'll have another leg up in the bull market. But I think we probably have to have some kind of a bubble type phase, a parabolic move up, and then that would be the end of the bull market that started at the bottom in 2009. So I don't think that secular bull is over yet, but I am worried that we might have a cyclical bear coming, especially if the war cycle heats up, or if we make the mistake of cutting interest rates and we ignite the inflation cycle again.
Gary, do you think that this concept of a stock market crash, I think maybe has become a little bit more popular in the last few years, as a lot of people have come out and are kind of calling for a stock market crash. But do you think that the sort of stock market crash of old times, back like the 1929 style crashes, remembering that the dollar was backed by gold at that time too, and so that probably played a role in it as well. But do you think that those earth-shattering, huge moves down in the general indexes are those a kind of a thing of the past? Are we sort of due to all the money printing and the currency devaluation, sort of destined to see bear markets sort of unfold where big crashes happen in real term, measured in gold? Do you have any thoughts there?
Well, we've had multiple of those crashes here in the last 25 years. We had one, obviously, in 2000. We had a housing market crash in 2007 and 8. We had a Bitcoin crash. The crashes are, you need to put the components in place for a crash, and that means you have to get stretched really far to the upside, and you have to have like irrational buying of assets. Something completely devoid of the fundamentals. Is just pure sentiment. You see your neighbor getting rich buying Bitcoin, so you want to get rich, so you buy Bitcoin, and so you get a lot of unsophisticated investors that are just they're just hitting the bid. No matter how wide the spread is, they hit the bid because they're worried about that their neighbor is going to make more money than them. And when you get to that point where you're having like the average person doesn't have any idea what he's doing, he just knows that, hey, I can get rich doing this. You're getting to the point where you're about to run out of buyers, and then when you run out of buyers, depending on how far above the mean price has stretched and how ridiculous the market has become, then that sets the stage for a crash. I don't really see anything that's in that position at the moment, but if we have to go through a cyclical bear market in stocks, which would probably mean a recession, and then the Fed prints a lot of money, then I think we could set the stage for that coming out of that, depending on how much central banks, how much liquidity they throw at the market to stop the crash and to try and prevent the cleansing. It could produce, a big, huge parabolic move, and then you would set the stage for a big crash.
Yeah. Gary, one of the sort of my favorite things about following your work over time is that you'll talk about the psychology that you see, the market psychology and investor and trader psychology around tops and around bottoms. And it seems like, from what I gather, that you observe and you see people doing what people are saying to you is that at market tops, it seems like everyone wants to buy, and then at market bottoms, everyone wants to sell. And you have a hard time convincing the average person to think the other way about it. Can you explain a little bit about that? What you've seen in some standout memories on that concept?
So, it's just basic human emotions. When things are going good and it looks like price is going to go to the moon, and maybe you've tried to pick a top once or twice and the market keeps going. And so at some point you just get, really greedy, and you just convince yourself that price can never go down. Housing prices never go down. Well, they do, and they did. Um, Tech stocks don't need earnings. We just need eyeballs. No, they need earnings. Um, and so you get in, and this even applies to smaller level, like intermediate tops. If price has gone up for 3 or 4 months, the people that at the bottom, like, I couldn't convince them to pull the trigger because they were afraid it's going to keep going down. So they couldn't buy low. Now those people, they can't see any scenario where the market can go back down. It's gone up for 3 months. It means it's going to go up for another 3 months, and probably another 3 months after that. And there's no way that you can sell right now because you're going to miss, a big chunk of this rally. And so you can't sell. And it's really hard to time tops. You probably will sell too early, and then there's going to be, um, really tough to not jump back in when you see price going up. Right? And I call it, you get to a stage where you have to control greed. It's like, at some point you have to say, I've made enough. I don't care if it keeps going up a little further. I just don't want to get caught, when everything unravels and we have a big correction, because markets don't go up forever. They have moves back down. And as long as you're not in the bubble phase, then those moves they have timing bands. So intermediate cycle declines are usually, they're measured from trough to trough. So the troughs occur about every 22 to 25 weeks, give or take a week or so. So let's say if the rally's lasted 20 weeks, you're pretty, you're in the timing band where the declining phase is going to start. So you probably need to control greed. Now, if you've been in the declining phase of the intermediate cycle, say for 8 weeks, and you're on week 24 of the intermediate cycle, now you need to go the other way. This is the point at which you're really afraid to pull the trigger, because every time you pull the trigger, it's gone lower, and you lose money, and you can't see any scenario where this market can bottom. In your mind, somehow the fundamentals have changed, and the precious metal bull market is over, and gold and silver will never go back up again, and there's no way you're going to buy, because if you buy a month from now, you're going to have lost 20%. But when everybody's has that mentality, everybody's afraid, you're running out of sellers, and the fundamentals have not changed. And the one rule, of course, is that bull markets make higher highs. Metals in particular are still in bull markets, so they're going to make higher highs. That includes silver, even though silver has been very frustrating. Silver's going to have its day. Stocks, I think, are still in a bull market, although they may be preparing for a cyclical bear market. So it's hard to fight that fear that if you get in, you may take a drawdown, but it's still a bull market, so the bull market's going to rescue any entries, even if they're not perfectly timed. You don't have to pick the exact bottom of corrections to make money in a bull market, because bull market eventually is going to resume and price will make a higher high. So you could even buy at the top of the previous intermediate rally. I've pointed this out before. It's like, you could look back and I've told people, you could have bought the exact top in 2022 in gold and silver, and then had to ride out that move into the 8-year cycle low, which would have been really painful. But now you look at that, where that top was compared to where it is now, you made a ton of money buying the exact top of that intermediate rally and then having to weather that move down into the 8-year cycle low. So the bull rescued, even a really poorly timed entry, it still rescued that entry, and you've still made a ton of money since then.
Gary, do you see this decade bearing any resemblance possibly to the 1970s with respect to gold?
Sort of, a little bit, maybe a little bit different. But we are in a secular bull market. We've just broken out of a 11-year cup and handle base, and the handle I think was maybe 3 years, 3.5 years. And so, I've said this multiple times, posted it on X and such. The rule is the bigger the base, the higher in space. The base in gold was about 11 years, I think, 12 years, something like that. Rather large base. And so we had a long, long ways to go. That is a huge base. My feeling is that, and I've said this before, $10,000 is going to be a piece of cake. Now, when I say piece of cake, that doesn't mean it's going to be a straight line there. There'll be some volatile, scary sell-offs along the way. I said the same thing about the NASDAQ when it was, hadn't even gotten back to 5,000 yet. I said, 10,000 is going to be a piece of cake. 20,000 is not out of the question. We're at 21,000 right now. We had some scary corrections along the way, but it got there. Same thing with gold. I'm pretty sure it's going to get to at least 10,000 based on the size of that base, but it doesn't mean it's going to be an easy ride to get there. It will be an easy ride to get there if you're in physical gold and silver. Very easy to hold through every correction. Nobody goes in every day and counts how many ounces of physical gold and silver they do and then get their calculator out and find out how much they're up and down every day. You only do that on your portfolio because you can open it up and it'll tell you right there what your portfolio is worth. That causes people to panic. Nobody's going to panic in their physical gold and silver. So by far the easiest way to ride the entire gold bull is get a big chunk of your investment capital in physical gold and silver. You won't panic in any of these corrections, and you'll ride this whole thing up. You won't overtrade, and you'll profit from the entire move until we get to the phase where the thing's starting to go parabolic higher, and then it's up to you. You got to control greed at some point, take profits on the way up, and not get caught when the crash.
Yeah. Gary, I know that you also follow the geopolitical dimensions and the war fronts that are developing in various parts of the world now. Do you follow that out of a genuine interest, or do you see there being a significant connection between those events and the gold price as an example?
A little bit of both. I'm somewhat interested in politics and the geopolitical field and stuff, and it is going to be. It will definitely be a driver for the gold bull, and probably somewhat of a driver for the commodity bull market in general. I said this about 2 weeks into the lockdowns when we just idiotic policies we did for COVID, but about 2 weeks into the lockdowns, this is going to ignite the inflation cycle, and when you ignite the inflation cycle, that ignites the war cycle, and humanity in general, when we start down these just stupid paths, we usually have to crash and burn before we come back to our senses. So I really doubt that we're going to be able to abort the war cycle prematurely. I think both the Middle East and the Ukraine are bad, but I think Ukraine is probably the worst one. And I just I don't see any way to stop it. Europe, basically each side has demands that they're not going to give up on. Russia is not going to give back the Russian people in the Donbass and Crimea. Crimea is their naval base. They're not going to give that up. And so any any peace negotiation that requires them to give that up isn't non-starter. But Europe is not going to accept any peace deal that doesn't include that. And so you're, I don't know how you end the war. It just seems like it's going to keep escalating until they eventually start World War III, I guess. I don't know. I'm not very optimistic that we can end that, because I just don't think either side will accept the terms that the other side would agree to in order for the hostilities to stop.
All right. So, Gary, the person watching this, let's say they have a significant portion of wealth that they want to protect, and they want to make sure that they don't lose, and that will preserve its purchasing power and possibly grow larger in size over time. What do you think are some things that they should be thinking about?
Well, I think the obvious one is gold. I think the obvious, but maybe not as obvious as gold, is silver. Silver will follow gold. It will have its time in the sun. I know a lot of people are just frustrated because silver, it's been since 2011 when it tested that $50 top, and it hasn't retested it yet. Although, we're getting close. We got to 40, or almost 40 here a few weeks ago. Once it breaks out above 50, look out. We're going a long way. And I've said this as well: $100 silver, piece of cake. $250 silver, probably, very likely, maybe even $500 silver. And we could literally go, this is just the way silver moves. It kind of comes on late in a cycle. We could literally take a couple of years to get, through 50 and to 100. And then we could go from 100 to 500 in the last 3 months of the bull market. It's a thin market. And once the money starts to flow into silver, it can make some huge moves very quickly. So silver will have its day in the sun. I think commodities in general will have its day in the sun, especially if we have a cyclical bear market here, because central banks are going to do what they always do. They're going to print more money to try and stop the pain. People will be beating the doors down. Do something, save me. And they'll print more money, and I think that's lights the fire under the commodity bull market, especially gold and silver, maybe to some extent cryptocurrencies, except turn the electricity off and your crypto is worthless. So, I think crypto is a good trading vehicle, but it's not something that I want to have to protect against really hard times. I want gold and silver. I want it in my possession, or somewhere where I can get to it, or in a vault that I trust that will hold it for me. So that would be my main thing. If you think like me, you think the war cycle's probably, there's no way to abort it. The inflation cycle's not over yet, and you need to protect yourself from that. You need some assets that will protect your purchasing power. I think gold and silver are probably your best bets.
All right. Well, Gary, I'd like to ask you about the Smart Money Tracker, the newsletter that you publish. And can you tell the person watching a little bit about it? And is there a way that they could participate in that with you at either a low risk or a no risk, kind of way? Do you have anything like that?
Well, at the beginning of this year, I kind of switched. I was doing monthly subscriptions, but you get a lot of kind of novice traders. They want to get rich quick, and if they don't make a lot of money in the first month, they just they go looking somewhere else for somebody that can tell them how to get rich quick. If they take a drawdown, the same thing. So I don't really want those kind of traders anymore. I kind of want more experienced people, and so I only open the SMT up. It'll open again in December, and I'll give people like 3 months, but I only do yearly subscriptions at this point. I want you committed for a year. I'm not going to promise you that I'm going to make you money the first month, but I am going to make you money over the year, and I'm mostly going to focus on precious metals for the most part. And what we try and do is usually there are two intermediate cycle degree corrections during the year. I try and spot those bottoms, get people in at those bottoms. And since we're still in the advancing phase of a new 8 year cycle, still pretty early in that 8 year cycle. And I tend to think we're going to get the final parabolic phase during this 8 year cycle. Then we use a little bit of leverage at those intermediate bottoms. And then when we get to something to where we need to control greed and take profits, then we take profits, and we don't worry if we don't time it perfectly, and we kind of twiddle our thumbs. Maybe we'll take a trade here and there in the stock market or Bitcoin or oil or something, but we never risk very much money in these trades. We just don't want to lose our gains. So, for instance, most subscribers have made anywhere from 50 to 100% on this first run up to that April top in metals. And we've taken a couple of little small trades. I made it clear to people, don't bet very big. You can bet a little bit on Bitcoin. We made a little bit on the Bitcoin run. Maybe if you want to bet a little bit on stocks, don't leverage. Don't risk losing those gains. Once we get the next intermediate cycle low, then we'll step on the gas again. I'm not sure we're going to get a recognizable intermediate cycle low right now because gold is just going sideways again. But at some point here, it's going to break out, and then we'll get another run. And when it looks like that's happening, then we'll kind of start to put a little bit of leverage on. And I think by the end of the year, most everybody will have made some really good money. And that's basically what I'm interested in doing from now until the end of the bull market. If that suits your mentality, you can be patient. You can ignore other stuff when metals are in a correction phase and just wait for the opportunity. Then by all means subscribe in December when I open the SMT up again for new subscriptions, and give me a year. Pretty sure I'm going to make you some good money over the year, because I don't think the gold bull market's going to end this year. I don't think it's going to end next year either. Probably not even in 27, maybe 28. So as long as the gold bull market is still ongoing, we're going to make good money. But you're going to have to be patient. You're going to have to be willing to ignore other markets while we wait for setups. And if that agrees with you, then, like I said, by all means, subscribe this December when I open it up again. But for right now, it's closed, and we're kind of biding our time, waiting for that second really good buying opportunity.
Mm-hmm. So I'm just showing here now a screen share of the Twitter X page that you have. Type in Gary Savage. It should come right up. The handle is Gary Savage 1. Now, is going to that X page, Gary? Is that the best place for people to start following your work?
Yeah, I occasionally post some stuff there. Not a whole lot, because I save most of that for the subscribers. I do post some political commentary there as well. And in December, when I open the SMT for subscribers again, I'll post it to X here, and so I'll make people aware of it at that point.
Well, Gary Savage, publisher of the Smart Money Tracker investing newsletter, thank you so much for sharing your comments with us today.
Well, thanks for having me, Tekoa.